SpaceX is one of the most talked about private companies in the world, and every time its valuation rises, the same question comes back. Should you buy SpaceX before the IPO? But here's the surprising part. For most people, the biggest challenge isn't deciding whether SpaceX is a good company. It's figuring out whether they can invest at all. In this video, we'll break down how pre-IPO investing actually works, why SpaceX attracts so much attention, the risks most people overlook, and what an eventual IPO could, or couldn't, mean for investors. And just to be clear, this video is for educational purposes only and is not financial or investment advice. Let's start with the question most people never ask first. Can you actually buy SpaceX today? The simple answer is not directly through a normal stock brokerage. SpaceX is still a private company. That means its shares aren't listed on public exchanges like the New York Stock Exchange or NASDAQ. So if you open your investing app and search for SpaceX, you won't find a ticker symbol. But that's not the whole story. Some accredited investors gain access through private market platforms, venture funds, secondary transactions, or special purpose vehicles. In other words, the shares may be private. The market around them isn't completely invisible, and that's where many headlines stop. Because once people hear private shares available, they immediately jump to the next conclusion. If I can buy them, I should buy them. But that's where things get more interesting. The attraction is easy to understand. SpaceX transformed the launch industry. Reusable rockets changed the economics of spaceflight. Starlink created one of the world's largest satellite internet networks. The company has secured commercial contracts, government contracts, and built businesses across multiple sectors. From the outside, it looks like the kind of company investors dream about finding early. And that's exactly why interest keeps growing. But here's the important distinction. A great company and a great investment are not automatically the same thing. A company can be incredibly innovative. Its products can dominate. Its mission can inspire millions. Yet investors can still face challenges depending on the price they pay and the structure of the investment. And that leads directly to one of the biggest misconceptions surrounding pre-IPO opportunities. Many people imagine a simple story: buy before the IPO, wait, profit when the company goes public. But reality is often more complicated. Some IPOs exceed expectations, others struggle after listing, and some spend years moving sideways despite enormous excitement beforehand. The key point is that an IPO is not a finish line, it's a transition. Once a company becomes public, millions of investors can continuously reassess its value. That means expectations matter a lot. Sometimes investors aren't buying a company, they're buying a narrative. And when expectations become extremely high, even strong business performance may not be enough to satisfy the market. But there's another challenge that receives far less attention, and for many investors, it matters even more. This is where the conversation usually gets serious. Public stocks provide constant pricing, extensive disclosures, and relatively easy liquidity. Private investments are different. First, liquidity can be limited. Selling your position may not be quick or easy. Second, transparency is often lower. Public companies regularly release financial information. Private companies generally disclose much less. Third, valuation can be difficult. Without a public market continuously setting prices, determining fair value becomes more challenging. And finally, timelines can be unpredictable. A company may remain private longer than investors expect, years longer. None of these factors automatically make a pre-IPO investment good or bad, but they do change the risk profile dramatically. And understanding those risks is arguably more important than understanding the excitement, because excitement is visible. Risk often isn't. At this point, many investors focus entirely on one company. But the space economy is much larger than SpaceX. Launch providers, satellite manufacturers, defense contractors, communications companies, infrastructure businesses. The broader ecosystem includes dozens of public and private participants. That doesn't mean they're better opportunities. It simply means that understanding an industry sometimes matters more than focusing on a single headline company. Because when people hear SpaceX, they're often reacting to the success story, but investing requires understanding the entire landscape, not just the most famous name. So, should you buy SpaceX before the IPO? The honest answer is that the question is bigger than it appears. Before anyone evaluates the opportunity, they first need to understand access, valuation, liquidity, transparency, timelines, and expectations. SpaceX may remain one of the most fascinating private companies in the world, but whether pre-IPO shares make sense depends on factors that go far beyond the company's reputation. And that's exactly why understanding the mechanics is just as important as understanding the hype. If you enjoy breaking down major investing stories without the noise, you'll probably enjoy the next video as well.